Welcome to Stock Market Basics Part 3, and we have completed Basics Part 1 and Part 2. Please refer previous videos so that you will get a continuity of what you are learning about Stock Market Basics, and today's section is all about Part 3. So hi, hello, this is Ganesh Thuru, your Stock Market Profit Coach and author of the book One Page Stock Market Plan. You can check out the book in the description link, and I help you in multiplying your money by investing in stock market. So today's topic is all about the basics of stock market, and we have covered two parts. And the way we had gone through the first two parts, here also we are going to just look at the third part, right? So the third part again I will just go through by the mind note mode. Just give me. Okay, so now we are in the third part. So the part three. So part one, part two, we are completed. Just to give a glimpse of what is available in part one. So we had seen about what is the company formations is it's all about, and what are the company shares, and what is the difference between stocks and stock shares, stocks and shares, and what is stock exchange and stock market, and how to invest in stock market, and what is the stock market regulations, why it is going up and going down irregularly. We don't know, right? So that is the reason we think that it's gambling. Once we know that why the hell it is going up and why the problem it is coming down, we'll know clearly, and stock market is a good place to invest, right? But and second part, we have discussed about who can invest in stock market, the differences between trading and investing, what is derivative trading, and what is the risk involved in both these kind of tradings, as well as what is the risk in investing in stock market, and can you invest based on SMS or emails. Also, the best books to learn and the best magazines you can look at. And finally, the bull vs bear market and what is called as uncertainty in stock market. Sometimes it will be very flat. You should be having conviction for the market to grow, and you should wait in that stocks, right? So are you having those kind of convictions? That is what we have discussed till now as part of part 2. Now let's go towards the part 3 part. So this is what you are going to see. And finally, what are the types of stocks? This is what we are going to begin in today's session. The types of stocks, generally if you ask, everyone will say there are three kinds of stocks: the large cap stock, mid cap, and small cap. This is purely based on the market capitalization. If the market capitalization means the number of shares multiplied by the stock price, very simple, is equal to the market capitalization. And if it is more than 20,000 crore, we call it as a large cap stock. And if it is between 5,000 to 10 to 20,000, it is called as mid cap. And if it is less than 10,000 up to 5,000, it is called as small cap. So this is called as, in a broad way, it is called as market capitalization. And these are the three different types of stocks. And why we are calling this as three types of stocks is why we are calling differentiating is that any large cap would have been in the market for a very very long time, right? Meaning maybe a 5-10 years down the lane, and the earnings should improve, and the market they should go through different economic cycles so that they are positive and they are growing year on year consistently. That is a status you will see any large cap company to be in. And if it is a mid cap, from small cap they would have come to a range where they started making profits, but at times they may negotiate, they may fall, and again they may get up, and they are tried to become a large cap. And small cap is something like they just started the company, and over economic cycle sometimes most of the companies will just go away in the same stage. So the risk involved is almost the same. In the large cap, the company can keep growing over a period of time. In mid cap, there will be a period of high growth, but still there will be a period of flat growth. But in small cap, there is a period of high growth, and there is a period of very big fall, and company will go out of market. The risk is in the same ranges: very high risk, moderate, and risk. But stock market risk is there in all the three, but risk is less compared to risk is less in large cap compared to a small cap stock. Hope you got the difference right now. Okay, the large cap stocks are called as blue chip stocks. So blue chip in the sense like the large cap is alternatively called as blue chip, and their market capitalization is wise very high. So you should, or you can always invest in blue chip stocks. So any recommendations, whatever coming out in the proper resource, proper channel will always be a blue chip stock or a mid cap stock. They go by the mid cap name itself, right? And there is something called penny stock. People will always go for penny stock, meaning it will be less, anything less than 50 rupees or 100 rupees, we can call it as penny stock. And penny stock in general will be around 1 rupee, 2 rupee, 5 rupees, 10 rupees, or 20 rupees, and you can buy in lots, thousands of stocks, say 6 rupees, thousands of stocks. If you want to buy, Even if you buy 1,000 shares of 6 rupees stock, it will be like just 6,000 rupees. You will buy thousands of shares. People will be thinking that I can make lots of money by buying a penny stock. But the problem with that is that from 6 rupees to 7 rupees, it will take months together, because the returns are, I think, around 5% itself will look 5%, but it will take 60 paisa for 10%. So think of 30 paisa will be 5%. Very rarely that kind of jump will happen in penny stock. So you should be very careful, and my suggestion will be, don't ever try to invest in penny stock. Even if you are a seasoned investor, if you are a beginner, you should completely avoid these kind of stocks. And in stock market, what kind of analysis you should do, and which is easy for me to do, because you should understand, right? I came into market knowing nothing. Nobody was there to tell about what analysis, how you should pick stocks, anything, right? So I thought this is very essential. Even in research analyst book by NISM, the SEBI authorized body, they say that you can do technical analysis or fundamental analysis, and all the technical analysis involves the charts, patterns, RSI indicator, sorry, RSI indicator, and all these things. So the chart patterns, everything. You need to know candlestick analysis, everything you need to know, so that finally you will be able to invest in stock. Look on a daily basis, or derivative trading, or swing trading. Everything is within a month. It is involved. Whereas when it comes to fundamental analysis, it is purely based on fundamentals of the company. Is the company doing good? Is the valuation is within the limits? Then you will always go and invest in that company. If the valuation is less, you can invest without any hesitation, and automatically the company can grow to the next level over a period of maybe 3 to 6 months. And if it's a long term, you can always trust fundamental analysis. Even in short term, if it is within 2 to 6 months, you can make money. Just think of in fixed deposits, it just they are going to make 5%, but if you're doing fundamentals and investing in a company, easily you can make good returns. But the point is, you should get the conviction. That is where people are losing money, because it's an emotion. I can say with conviction that you can invest, but if you feel that my money is going down, my money, what will happen, I need this, all these fears running in your mind, I can't control that. That is where people lose money. That is the reason profits differs with people. It's not the same with people. The same stock, people who bought at the same level, but they would have sold at different levels. That is where the difference between a person who understands stock market, the person who understands but not practically implements. That is what I can say. And there are two types of approaches even in fundamental analysis. One is top down or bottom up. Top down is, you will look at an overall sector, maybe IT industry or automobiles. You will invest across the sectors, because this is the momentum based, and I will invest in across the sector. Something called bottom up, in IT sector, which companies with good valuation, you will invest in it. But if you ask me, a proper approach is go broad based, which sector is going up, and in that pick one or two stocks which can do excellently good. You can look at the do qualitative analysis, quantitative analysis, and come to a point that it is a very good approach in stock market, right? So the two approaches, top down and bottom up. And if it's a bull run, if it is a top down approach, most of the stocks across the sector will start going. So this is how the market will keep going on, right? And making money is creating wealth, and this should be the answer question I should have kept at the beginning, because what is your intention in stock market? Is it making money or creating wealth? Because both has different mindsets. If it is like creating wealth, it will take a long term, say 1 year, 3 years, 5 years, because it's like buying a real estate. You buy something, you hold it for a long term, for sure it will grow. But if you want to, if your intention is making money, for sure it will you may be thinking of selling it off quickly. The mindset itself requires a huge shift, right? So making money is a different mindset. You can make money in 3 to 6 months timeline. You should wait at least for that period, so that you can invest and make without making losses, you can make money. And the next one is dividend in stocks. This is another one thing, because dividend is nothing but the extra profit what the company wants to share with the shareholders. Say for example, you bought HCL Technologies as a company, and HCL Technology as a company has done exceedingly well in this quarter and in this financial year, and the management and the board decides that we want to give profit sharing with all the investors. They make sure the excess money, certain amount of money is there for cost, depreciation, everything, and certain amount of money is kept for future development or whatever with the company. and certain amount of money they want to distribute among the investor, among the shareholders and investors. They will take say 1 crore and divide among the 10,000 shares, for example. They will do that, and every person will say that we are going to announce a dividend of 5 rupees per share. And each person, how many number of shares? If you hold 100 shares, you'll get 500. If you hold 1,000 shares, you're going to get 5,000 rupees, right? This is called as dividend. Extra money whatever the company is having, if they are sharing that profit with the investors, that is purely dividends. And if you can check out in the stock market, there are companies which provide purely dividends, dividend based companies. Most of the PSU, be careful if you are investing in public sector unit companies, they provide constant dividends in the range of 7 to 10%. Just think of fixed deposit is just 5 to 6%, whereas some of the PSU companies and some of the companies are giving dividends in the range of 7 to 10%. So that those are the companies we should focus on. And based on the stock price, remember that is based on the stock price. If the stock price is going up and up, the dividend ratio will come down to 5% or 4. But it purely depends on currently at present scenario for the last 1 year, it is in the same range. So just look into it. And finally the taxation part. And taxation also, there are two things. One is long term capital gains and another one is short term capital gains. Long term capital gains is nothing but, say you are investing a lakh, and after 1 year, and say your profit is around 1,50,000, then the invested amount is deducted and the profit is 50,000. As it is within the limit of 1 lakh, it is completely tax free. And suppose if you are investing a lakh and if you are making a 1.5 lakhs profit, say the total profit is 2.5 lakhs, then out of that 1.5 lakhs, 1 lakh is tax free and remaining amount is 10% of the tax. So that is how you will calculate tax. And short term capital gains, almost like it is based on 15% within a year. If you are making a profit and if you are selling it off, you will be getting, you need to pay 15% of the profit. And if there are losses which happens in the last in between, if you are taking a delivery, you can show those losses for the next 8 years. But if it is a speculative loss, you can adjust again the speculative losses. I think speculative losses are not considered, but losses in stock market you can take it off against the profits what you make in the subsequent years. That is how the benefits are provided. So purely for investments, benefits are provided, but if it is for speculative, there is no extra benefit in stock market. So hope you got a clarity on how you need to practice, right? So this is how you're going to invest. So types of stock, right? What are the three types of stock, and what is blue chip stock, what is penny stock, and what are the two types of analysis you will do in a company, and two types of approaches in stock market is top down and bottom up. And finally, making money is creating, what is the mindset you should have in life, and what are the dividends, do you need to focus only on dividends. And finally the taxation point of view, long term capital gains which comes at 10% and more than a year, this long term. And short term capital gains, it comes at 15%, right? So this is how you will start you will start investing in stock market once you know the basics. Please watch the videos of part 1 and part 2, and on top of it go through the part 3, and you will get a clarity like should you invest in stock market. Because once you know the basics, then the point is you need to understand how you should choose stocks and invest. And if you are interested, you can check out my description link. I had given my webinar, so you can come over the webinar and see whether it will be of any useful, right? Because once you learn, you can implement, and once you implement, you will start seeing money and you will start investing more. You'll start making more money in your life. Thank you so much for watching. Please share this video with your friends who wants to know about stock market, who wants to learn and invest and make more money. Thank you.